Hello, investors and future investors. Welcome back to the channel. For today's video, I'm going to show you how to do some basic due diligence right here on Robinhood if you're trading with a small account and if you're pretty new to options. Now, if you're looking to get into options or you're looking to use options to supplement your 9 to 5, then you just happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to use basic due diligence and two indicators I use most of the time before I determine what strategy to use, what strike price to use, and basically what my risk to reward ratio is going to be in order for me to be consistent with income. Now, we're going to go ahead and we're going to get down and dirty with options. So for today's video, we're going to be using AMD, which is Advanced Micro Devices. Now, once you have any stock open, remember, we're not going to pay attention to the stock. We're going to be paying attention to the strategies and my thought process when getting into these option strategies. So now we're going to go ahead to Robinhood Advanced feature, and this can be done in any brokerage. And then now we're going to go to the 3-month mark. Now, the reason why I use the 3-month mark is because I usually do weekly options and monthly options. With selling weeklies and monthly options, I don't need to go out that far. So I basically stick between the 3-month period and the 1-year period. So now we're going to start off with the 3-month period. One of the main indicators I use is going to be this blue line right here. Now, let's go ahead to the left and I'm going to show you that blue line is your MA200 or your 200-day moving average. What this does is that it gives you a trend line of where the stock is trading over a given period of time. In this case, it's going to be 3 months. So if you follow the blue line all the way to the end, what it's telling you is that within the last 200 days, the stock has been traded at an average price of $152. Currently, the price is $121. Let's just round it up. And that price happens to be below your 200-day moving average. So for me, right away in my mind, I would buy the stock outright. However, on this channel, we focus on options for small accounts. So I know many of you not going to be able to afford buying 100 shares. So stick with me. I'm going to show you how to afford trading this stock. So we're going to go ahead now to the 1-year mark right here in order to get some kind of confirmation. So now we're going to follow the blue line once again. And once again, the blue line is still giving us confirmation around that 150 mark. And once again, the strike price is still below your moving average of the 200 days. Now, the moving average is just one indicator I use. I'm going to go ahead and jump into a secondary indicator I use. And that's going to be this line right here. This line right here is known as your RSI or your relative strength index. This one gives you the movement of the stock once again over a particular period of time. In this case, it's going to be the 1-year mark since we have that open. Now, any price between your $50 mark, which is right here, and your $70 mark, that tells you that that particular stock has been overbought. It means everyone is just buying this thing out. And the reverse of that, any price below between the 50 right here and the 30 down here means that that stock has been oversold. When a stock is oversold, that means people are getting out of the stock for whatever the reason is. So any price between the 50 and the 70 overbought and the 50 and the 30 oversold. AMD is currently trading around 44. So that means it's in oversold territory. So now I have 3 signs that this stock is a good stock to pick up outright. 1, the RSI. 2, the 200-day moving average. And 3, the share price is below the 200-day moving average. So let me go ahead and show you the strategy I would use for this stock. So let's go ahead. We're going to go back to AMD. And now we're going to go ahead and open up our options chain. Let's go ahead to trade AMD options. So now we're going to go ahead to sell and call. And now we're going to choose our strike date. So you're very new to options. You have no idea what strike date to choose. Well, that's very simple as well. You use whatever the market is giving you in order to make an informed decision. So for instance, I'm not going to choose the January 10th strike date because everyone knows the market is going to be closed tomorrow. If the market is closed tomorrow the 9th, then that gives you 1 day to expiration. I personally don't like the risk reward ratio with trading 1 day to expiration options. So I'm going to go ahead and choose the next strike date. That next strike date happens to be January 17th. Now, with the January 17th strike date, that gives us 8 days to expiration. Now we're selling right here. So we, the seller of options, mean we're going to receive a premium when we do this strategy. Now, because we're selling this option now, that means it's only going to be 5 days to expiration for us. And the reason for that is because Saturday and Sunday, the stock market is closed. Although the stock market is closed, the buyer of the option is losing premium. So let's go ahead, go to January 17th. And then now I'm going to go ahead and choose my strike price. So I'm going to go ahead and choose a strike price of, let's go with the 130 strike price right here. And with the 130 strike price, I have a pretty decent chance of profitability. You see chance of profitability up here. So I'm going to go ahead and I'm going to click into that. Now I'm going to go above and go back to buy and call once again and maintaining the exact same strike date. I'm going to choose the strike price right above our sell call we did previously. And that's going to give me the 131. So now I'm going to go ahead and I'm going to click into this one. So the strategy I would use for this, if I can't afford to buy the stock outright, would be a call credit spread. Now, there isn't just one strategy you could use based on where the stock is trading right now. There's several, but this is one I would definitely use if I was still trading with a small account. Now, with the call credit spread, like most of the options we feature on this channel, you're going to be receiving what's called an option premium. Means you're going to be getting money as soon as you do the option strategy. Now let's go ahead. We're going to hit continue. And the money you're going to be receiving is going to be $11.92. Let's round it up to $12. Let's go ahead. We're going to hit review. And this is the strategy. Now comes full throttle. So in order to do the strategy, you're going to have to leave $100 collateral. When I'm doing option spreads, I like to have a return of at least 15% to 30%. If you were to divide your 12 by 100, that's going to give you 12%. 12% is not good for me because I don't like getting only 12% from risking $100. So, like I said, I'm walking through your basic due diligence, which is going to help you to determine your different strike prices. So, what I'm going to do now is that I'm going to go back to the drawing boards. So, I'm going to deselect this one. I'm going to go back to my sell call once again, deselect it once again, and now I'm going to go a bit lower down. I'm going to go now to the $128 strike price, which a much less chance of profitability. The previous one was 86%. This one is 82, so I reduced the chance of profitability. However, I'm getting way more money, which is going to be 0.98. If you multiply 0.98 by 100 shares, because once you do an option, is in multiple of 100, that's going to be $98. We're going to continue with the exact same strategy. And now we're going to go ahead and get our buy call. And we're going to go ahead once again and do the exact same thing and choose a strike price right above. And for that, we're going to have to pay 0.82. We're going to go ahead. We're going to hit continue. We're going to hit review order. And there you go. And now, because I made that slight adjustment, I have now increased my premium and also my percentage return. So now my premium is going to be $19 and my collateral is still the same of $100. So now my return is going to be 19%, which fits into my risk reward ratio for this particular option strategy, the call credit spread. So with my 19% return, I'll be very satisfied with that. Now we're going to go ahead and we're going to go into a secondary stock and we're going to do pretty much the same thing. But once again, I'm going to be walking you through to see why I chose that particular strike price and that particular strike date. And for that one, we're going to be using Sound AI, ticker SOUND. Okay, so here we are on Sound AI and taking a quick look at this. Before even doing basic due diligence, you could see the stock is down at 16% today. If any stock is down at 16% in one day, you need to do some extensive research if you're not familiar with the stock. I, on the other hand, is very familiar with the stock. I do have it in my portfolio. Always trade the same stocks over and over again. That's how I learn about these stocks. That's how I know how to trade them properly. So now we're going to go ahead to our advanced feature once again. And we're going to go out to the 3-month mark once again. And we're going to be using the 200-day moving average once again. Now, with the 200-day moving average, you could see the stock has been trading at 660 in the 3-month period. So in this scenario, however, the share price is above your 200-day moving average. So let's go out to 1 year to get even better confirmation. Okay, so here we are at 1 year, and we're going to use the 200-day moving average once again. And as you can see, it's around the $6 mark. In this case, what I'm going to be doing is I'm going to be looking for support and resistance. So follow this line right here. You see the top here. If you're going to go out to the other side, you're going to see it right here. Just follow this white line right here. So now we have two resistance points. The reason why they're resistance points is that previously the stock hit this twice and was not able to go past it. Currently, the stock is trading above this point. So now this resistance point has now turned into what's called a support point. And that support point is around the $8 level. Now, if we go a bit further up, we're going to see that we have another support level right here, which is around the $13. Now, this one does not have any confirmation because it's only one. As I showed you right here, there's one here and there's another one here. This one just has one. Now, I'm trying my best not to sound like a day trader, but just bear with me. So now we're going to go ahead to the stock, and I'm going to show you what strategy that I'm going to use if I decide to trade Sound AI. So now we're going to go ahead to trade Sound options. And the strategy I'm going to be using now, we're going to go to sell and we're going to go to put. The reason for that is that the stock is trading above the 200-day moving average. So I would never buy this stock outright. What I will do, however, if I decide to trade this stock, is that I'm going to go and try to see if I could get the stock at a much cheaper price. Now, why would anyone want to trade this stock? Well, as an option trader, you always try to find stocks that give you that juicy premium that make it worth your while. Sound AI just happens to have some really nice premiums right now. So I'm going to go ahead and choose the strike date of the same one we used previously. And I did explain to you why we went with the January 17th strike date. And with this option strategy, I'm going to go now below the share price because I'm not going to buy this outright. Now, we did see that the primary support was around $8 and the secondary was around 13. So what we're going to do, we're going to go ahead and we're going to choose let's go with the $9 price. So with the $9 price right here, I have a very high chance of profitability. However, I'm only going to get paid 4 cents. So in actuality, I'm going to have $900 of my portfolio reserved in just waiting for this stock to come back to $9, but I'm only making $4. In my mind, that trade just does not work for me. The risk to reward does not work. So what I'm going to do now is that I'm going to go look for a secondary price. So the price I'm going to go with is going to be the $12 price. Now with the $12 price, I'm going to be getting $25. Now I'm going to get back to that premium in just a second. The reason why I chose the $25 as opposed to the $13, as you saw, the next support level was around the $13 mark, is my chance of profitability. I'm way closer to the share price than if I had the $12 strike price. The other reason to choose the $12 one is that we also saw the primary support was $9. If the share price does break $12, I am pretty sure it's going to go down to the $9 mark. Even if it goes past the $9 mark, it's going to come back up quickly because we did get confirmation. The stock usually trades around that level. Now, if I choose the $12 strike price and the stock does go to $900, that means my portfolio is going to be down only $300. As opposed to if I go higher, it's going to be down a lot more. Hopefully you guys understand that. Now, with the $12 strike price, I'm going to be receiving 0.25 or $25. Once again, each option contract is multiplied by $100. So the strategy I'll be using on Sound AI is going to be the cash secured put. We're going to go ahead, we're going to hit continue. We're going to hit review. And now we're going to see what our percentage return is going to be. So we're simply going to divide $25 by $1,200, and that should give you around 2%, I believe. Now, as opposed to the first option strategy, which was the spread, with the cash secured put, I do not mind making anywhere between 1.5% and 3%. The reason for that is that this is a completely different strategy. With a gain of between 1.5 and 3%, I could do my trades once a week. I could continue the rest of my life not having to look at my phone every single second. So that's why I like between 1.5 and 3%. Once again, the whole point of me making this video is that I walk you through my rationale in why I choose the strike prices, why I choose the strike dates, and how I come up with the different premiums that I receive in order for me to continue to grow my portfolio consistently. Now, sometimes I do get a percentage way more than 3%, and that's fine as well. Sometimes you're going to get a percentage just slightly lower than 1.5. That's fine as well. But I want you to remember one thing. No one is going to know what's best for your portfolio better than you do. And once again, the point of doing this video is for you to come up with your own due diligence, as basic as it seems, and come up with your own risk to reward ratio. And that is how I decide what strike prices I'm going to use, what strike date I'm going to use, and most importantly, what strategy I'm going to use, all depending on some basic due diligence that I use on Robinhood. Now, if you got any value from this video, go ahead, like the video, subscribe to the channel, and most importantly, if there's anyone out there struggling to grow a small portfolio, feel free to share this with them. And until the next video, keep pushing your investments.